Welcome to the OR Talks podcast. Here are your hosts, Neil Seeger
and Marc.
So, back to again.
Yeah.
New tax year.
It is. Literally right at the start. Happy New Year.
I was about to say happy new tax year, but you beat me to it. So today we're going to do the normal format.
Yeah.
We'll start off with a myth. Marc's myth of the month.
Yeah.
So what is your myth of the month this month, Marc?
So this is one that loads of people have probably seen all over Instagram, TikTok, and one of my friends actually sent it to me asking whether it was true or not.
Ooh,
yeah.
Come on then.
And it was all about gifting your house. So how it's set up was making it out sound really easy and really useful to gift your house to your children.
Okay, yeah.
As a way of getting out of inheritance.
So your house you live in?
Yeah, the house you live in. We're not talking about rentals here. The house that you live in.
Okay.
You always have lived in, just to be clear. Gifting that to your children.
Yeah.
Saying there's no capital gains tax.
Yep.
Falls out your estate for inheritance tax.
Yeah. No stamp duty?
No stamp duty, nothing being paid for it, it's a straight gift. So it's saying like no tax consequences, but it gets it out of your estate for inheritance tax.
That's perfect. So if I've got £1 million in cash,
yeah,
right, and I give my house away.
Yeah.
So if I'm worth 1.4 million, my house is 400 grand.
Yeah.
I give it to my kids. I'm only worth £1 million.
That's the theory behind it, and
Yeah.
that's why it sounds brilliant.
So why does it not work?
There's a lot more to it. In the TikTok videos, Instagram posts, they don't go into enough detail on it because it sounds brilliant, like you've just come across it there. Brilliant, my estate's now worth less.
Or if I actually, let's just say it's just me by myself, and
Yeah.
I've got my house, so I'm divorced.
Yeah.
And I've got my son. So I decided, well, actually, my house is worth 600,000.
Yeah.
Okay, so I've done that number on purpose because you've got your 325
Yeah.
that you have anyway, 325 inheritance tax allowance. Then because I'm using my house,
Yeah.
I get my extra 175.
Yeah.
So that's £500,000.
Yeah.
My house is worth 600.
Yeah.
So at the moment, I'm going to pay my estate will pay tax on 100,000.
Yeah.
So if I give my £600,000 house to my son,
Yeah.
I'm out the woods.
That is what these posts are coming at.
Yeah.
Unfortunately, it doesn't quite work like that. So if you gift the house that you live in and continue to live in it afterwards, it doesn't fall out of your estate for inheritance tax because you're still benefiting from
Yeah.
that asset that you've given away in theory.
Okay.
So it's called a gift with reservation of benefit.
Ooh, okay.
So that's the
That's
technical.
one to Google.
That's the technical term for it. So what it means is if you give something away, you
Yeah.
can't continue to benefit from the use of that and it fall out of your estate.
Right.
So if you give the house away but you no longer live in it, you move into somewhere else, that's absolutely fine. It will fall out of your estate providing you survive 7 years.
So what happens if I gave it to my son
Yeah,
and I rented it back off him?
yeah. If you're paying market value rent,
Yeah.
that's absolutely fine. Obviously your son's going to have to pay tax on their rental income.
Yeah.
But yeah, that's fine then. That doesn't count as a gift with reservation of benefit.
So it comes out of my estate.
Yeah.
So I get that benefit, but it
Yeah.
depends on how long I live.
Yeah, it's
whether it ends up being
subject to the
beneficial.
7-year rule
Yeah.
still. That is.
Okay.
Yeah.
So so I've heard this quite a lot actually, and I've seen this on a few videos where you give your house to your child, and what
Yeah.
you do is you pay a peppercorn rent. So I rent it for £100 a year
Yeah.
to minimise my son's tax exposure, and I have like a repairing lease.
Yeah.
That's fine because I'm repairing the house.
Yeah, yeah. You're maintaining it and everything. Yeah.
Yeah. Does that work?
So the problem is it's got to be market value rent, isn't it?
So if it's not market value, so
Yeah.
okay, right. So it's not based on the rent that I necessarily. It's not based on the repairing lease. It
Yeah.
has to be what would normally be commercial if I was to rent it off somebody
Yeah.
else.
Yeah. If it's what you
Right.
rented to someone down the road that you don't know, you've got no connection to, basically,
Okay.
it's got to be a commercial basis in order for it to fall out of your estate. The other thing these videos don't really touch on is the fact that if you're a married couple,
Yeah.
if on the first death, none of your nil rate band, your 325,000, is used, the surviving spouse inherits that when they pass away.
So they could have 650.
Exactly.
Right.
And the same applies to your resident nil rate band. Now they sometimes pick up on the fact that you've got the resident nil rate band as well.
That's 175.
Yeah.
Okay.
Which is
right.
only used on the house that you're living in.
Yeah.
And it only get that if it's passed to a direct descendant, so that's children or grandchildren.
Yeah.
But the other thing that they never pick up on is if your whole estate's worth over £2 million, that resident nil rate band is tapered away. So if you've got really fortunate, you've got an estate worth more than 2 million, that resident nil rate band likely isn't going to apply for you.
So if I'm worth 2 million, let's just break that down. So my house, all my assets, everything is worth 2 million quid.
Yeah.
So I would expect that £1 million of that is so.
It's provide you.
I've had the allowances off my
Yeah.
wife. Yeah, I'm on second death. So my wife sadly died and whatever. Great. Okay. So we're now in a position where we've got £2 million of assets.
Yeah.
£1 million because I've inherited her allowances. So therefore, only 40% of the £1 million is taxable.
40%, yeah, £1 million is taxable at 40%.
Yes.
Yeah.
Yes.
Yeah, but if you go over the 2 million, you're losing that 175 resident nil rate.
Right. So if I'm worth 2 million, so 2.1 million,
yeah,
I'd lose it.
Yeah, exactly. So you start to lose that.
Start to lose it. Okay.
Yeah. What's something else I was going to say on that then? Me from it.
I do that. I fire these questions and then throw you off.
So these are just the finer bits of detail that don't come up in the videos. They make it sound really simple. And the really worrying thing is people will act on that without taking more advice.
Yes.
So gifting the house, you're thinking and still living in it, that's something that people would easily do by just taking advice off these little short TikTok videos.
I know a lot of people that have done exactly that. The other thing I know what people have done, and I've seen this on videos, is that so they've lived in their residential house and they gift that house not to children but to a trust.
Yeah.
Okay. I'm seeing that on videos left, right, and centre in a very similar concept. But if you give it to a trust, which has the beneficiaries, let's just say, of the children, which is effectively the same effect as giving it to the kids, really. Am I then in the same boat as I've got to pay market rent to the trust?
Yeah, in theory you want to keep it all market rent all the time.
Because I know a lot of people that have transferred the property to their trust.
Yeah.
They're not paying any rent. The trust is owned by the kids.
Yeah. So you're still giving away an asset and retaining the benefit of that.
So they're not going to get the exemption they think they're going to get.
Exactly, yeah. There's a lot more to it, and every case is going to be slightly different.
Yeah, but they're quite common though.
Yeah, it's a scheme that people come up with, and it's a way of sucking people into doing things and just not taking the full advice and getting caught out that way.
So legally it's out your name,
yeah.
Tax-wise it's not.
Yeah, that's it. Because you're still benefiting from it. And that doesn't just apply to houses, that's any asset that you give away if you still retain the benefit. So something people sometimes try and do is do this with cash.
Yeah.
They'll give their children cash to bring it out of their estate,
yeah.
and then their children will buy something that the parents would have wanted. Because that's still in that circle, the HMRC would challenge you and say, well, actually, you're still having the benefit of that cash because the asset that was bought with it, you're benefiting from.
So if I had £200,000,
yeah,
and I bought a Bentley,
yeah,
and I then basically, so my dad gives me the money, it's out of his estate.
Yeah.
I then buy the Bentley,
yeah,
which me and my dad are insured on.
Yeah.
My dad's still getting benefit of that Bentley, isn't he?
He is, yeah. So there's an argument there, depending on how much use he's having. If he's borrowing it every once in a blue moon,
yeah, it's.
But if he's having exclusive use of it and using it almost every day,
we're doing it just to get it. You're doing it to avoid it, aren't you?
Yeah, you're doing it to artificially bring the estate.
Move it out.
Yeah.
Wow.
So it's just something else to be looking at.
It's always worth consulting if you're thinking about giving money away and that sort of stuff, isn't it?
It is, but property is the main one where people attack and go through because everyone worries about their home. People are proud to have got to a point where they've got their own home and they don't want to lose it to inheritance tax.
Correct.
So little things like this.
Or other factors that come into play, like social care. I'm not going to go off on a tangent, I promise.
No, that's the other thing to be wary of. We can't advise on it, but care home fees and things like that, if you've given your home away, they can challenge it and say, actually, you've done that only to get out of paying care home fees.
Clearly see it's anti-avoidance legislation, isn't it, that comes in.
Deprivation of assets, isn't it? So,
ooh.
Big words today.
That is a big word, that is. I'm not actually able to spell it.
Yeah. So that's just a little myth buster on inheritance tax and gifting your property.
Oh. That's that's inspired the Neil's knowledge. So because I was going to look at on a similar sort of thing, and because and the reason we talk about property is that there's a change in the renting legislation coming out in May. Comes into effect. I can't remember the exact date in May, but it comes out in May, which is changing the landlord's rules and the people that rent properties rules for them as well. So we're getting asked an awful lot about moving properties out of people's names, how we can transfer them, and you'd be surprised the amount of people that are trying to sell properties, or the parents, let's just say, don't want the hassle of the new rules that are coming in, and they're saying, well, actually, can I just gift my rental properties to my children? Because if I gift them to my children, I don't have the hassle anymore because the asset's moved, and my estate is worth less. Okay, so it's on a similar sort of line to what we were talking about there. So if I've got 3 rental houses that I have got, they haven't got mortgaged on, let's keep it simple, and I gift that to, I decide actually I don't want the hassle, I'll give it to my children. Because I've got they don't pay me for them, I just give them. I don't pay tax on that, do I?
That's not correct. So that's another misconception that's out there. So whereas when we were talking before in the Mythbuster, that was your own home, that's covered by main residence relief. The rental properties aren't. So when you gift something, it's deemed to happen when it's gifted to a connected person like your children to happen at market value. So in the case of your own home, any gain from market value to what you originally bought it for is covered by main residence relief. Rental properties aren't.
So I'd pay tax on that?
You'd pay tax on the amount that they've gone up in value from the date that you bought it to the market value when you gift it.
So I wouldn't pay any tax. So I would pay tax on that. Capital gains tax on that. So it's not free. So some of the videos are saying that you can do that, but you can't.
Get it out of your estate.
And there's a little thing called stamp duty that appears. So stamp duty would that apply if they weren't giving me any money?
It won't apply if there's no consideration unless there's a mortgage on the properties, which in your case you just said there wasn't. So
I'll keep it simple.
In your one, no stamp duty. But if there's a mortgage and that's been passed over with the properties, they'd pay stamp duty on the value of the mortgage debt.
Because we're seeing it a lot where people are paying off. So the parent will say you can have the property, but you can pay the mortgage off. So there's a mortgage. Let's say there is a mortgage on it, and it's £200,000 property, and there's a 40 grand mortgage on it. Okay, so I say I'm going to give my son the property, and all he's got to do is pay the mortgage off. So he's not actually paying me any money.
In your case, you've used figures that don't quite work because 40 grand on stamp duty would be nothing.
Okay, all right. Let's just say it's $500,000 with a...
Yes, you would. On a $500,000, if you're taking on that $500,000 debt, that is your consideration for the property for stamp duty purposes.
So the 40 grand example wouldn't attract stamp duty.
Just because of how stamp duty works.
So what would the level be on that?
So if you already own property, you're going to pay the additional rates. So it'll be the standard rates plus 5% on top of each rate. So
if it's 40 grand.
40 grand you're going to have nothing because it's just of how stamp duty works. But above that, you start off at 2%, don't you? So 2% plus the 5% additional, 7% could be the standard rate.
Because it's worth looking at the value of that debt as well, because it might be that £100,000 does kick into it, or it might be that it doesn't. But it's worth looking at those individual circumstances that whether that all works or doesn't. But that's a myth, isn't it? Saying that you can transfer it's a myth and a knowledge really, because you transfer your property, you pay no tax. Your rentals, well, that doesn't necessarily work.
You have the capital gains tax, which some people are quite happy to pay because they're passing it down, and it's cheaper than what the inheritance tax at 40% could potentially be further down the line. And your children are getting an uplift in the value of the property for their base cost if they then wanted to sell it.
And the same applies if you move it to a limited company, doesn't it? So the same rules will apply whether you're giving it to your kids or you're giving it to a limited company. The same rules will apply. There's no getting out of it.
Unfortunately not, no. This is something that you will see schemes on as well on Instagram and TikTok, ways of getting properties into a limited company. And it's never really as straightforward as they make out. There's a lot of loopholes you have to go through, and a lot of the time, if you've only got 1 or 2 properties, it's not feasible to go down that road without paying the tax. If you pay the tax, fine, you can do it.
There's plenty, exactly. That's the thing, isn't it? It's paying tax and exploring the options that are there.
That's it,
So obviously, and then the other thing we've got to sort of look at is if people are just selling, they're not gifting the properties, they're just purely just going, do you know what, I don't want to rent my property anymore, I'm going to sell it. So if they sell it, then the only thing they're going to pay is capital gains tax between what they bought it for and what they sell it for.
Unless if you've put an extension on the property and things like that, that can come off the price of it as well. And if you have lived in it at any time as your main residence, that period can be exempted as well. But really simply, what you sell it for, less what you bought it for, and any sort of associated estate agent fees, solicitor fees.
I think that covers up a lot of the things that have changed. And obviously with the new rules that are coming in, if so you've got to upgrade the windows, upgrade the boiler, or put a heat pump in, or whatever the new rules are requiring. And even if you've got an older property and you're looking to bring it up to standard, you can claim the majority of the costs that you can. I'm not going to say all the costs because there are some that aren't allowable, but majority of the costs you can actually pay. You can actually get tax relief on.
Yeah, you should be able to. It's very much a case by case. It's going to depend on the property and the work that's being done. But as a rule, if you're bringing it up to a modern equivalent standard of what was previously there, that's fine. So if you buy a property with single glazing, you're putting in double glazing, that's the modern equivalent standard. So
it's triple now, triple glazing.
Yeah, I'm behind the times. But yeah, that sort of thing, you're just bringing it up to the modern standard. So yeah.
So that would be just a
revenue expense.
Yeah. That's all I have for property for the knowledge section.
Yeah, it's good. It's just things to be aware of and not to get caught out by and don't get sucked in by what you see on social media all the time.
Absolutely. If you do see a video like you know Mark's friend sent over to him actually saying that, and if it feels too good to be true, it generally is.
Yeah,
it generally is. So if you've got any questions on that, please by all means contact us. I'm more than happy to talk to you about the options and whether that is true or not.
Yeah.
Until next time.
Well, thanks for joining us. Hope you found that useful. And like Neil said, if you've got anything you want to send in for us to pick apart, you know the WhatsApp number?
It is 01905 777 600.
Until next time, thanks for joining.
Thank you.